Hey traders, welcome to Charts and Coffee. Happy Friday, everybody. Hope everyone is doing well. We're taking a look at these markets before they open. We've got non-farm payroll being digested at the moment. You can see there's your non-farm payroll candle. And what I usually recommend to traders is once we get the 8:30 a.m. non-farm payroll candle, we're going to have that headline reaction. So what is that headline reaction? Well, let's jump on over to the calendar over at Forex Factory and jump on down. Here we go. So unemployment rate 6.5. All right, that's not exactly what the Federal Reserve would want to see. Non-farm payroll change was insane. So you're wondering, are we selling off because of the 6.3 versus 6.5? We're selling off because this was a huge number. Expectations were for 110. Previous was 510. Current is 467. So this is an unemployment rate went up a tick. So usually when traders see this, oh, it's bad news. The markets are going down. Now remember, we're in that interesting little window, and we've been talking about the best way. If you haven't checked it out, I alluded to it in previous videos. I believe last Friday, I got into this in the free video. How do you use target rate probabilities? How do you block out the noise? And we're going to dive into this a little bit more in the Countdown Trader next week. So check out countdowntrader.com and we'll have an update on this particular topic. So what I'm most interested in is, does March go up in expectation? Does May, in terms of a rate hike, continue to move higher towards 80? Does June have more clarity towards a third consecutive meeting rate hike? And right now, that NFP is looking like it probably nudged. Well, March has been set. May's been pretty darn set. And then June is looking like it's on its way to that 80% threshold. It wasn't quite there, even this close yesterday. And then do we have any clarity for July? But, not enough. It's a little too far out in front. We can keep an eye on it, but this is where we get that understanding for how is it being digested, not looking at consensus and expectations and then the actual, but how is the market actually reacting? The market's not going to like this number. It's a huge number, and the indices are not going to like this. Now, I want to remind everybody that the NASDAQ has been in a downtrend. So when folks do ask me, hey, Rog, do we have opportunities to short the rip? Yeah, XLC, I talked about. XLK is a no. XLY is fine. QQQ, NASDAQ. Anywhere we have bearish momentum, bearish trend. Okay, so that is what we've got going on here this morning in the wake of NFP. If you're curious what gold is doing, not too much. Gold is not a flight to safety. Gold is a play on real yields, and you can see there not a huge significant move outside of a range that we've already been in. Here is the move I've been talking about for some time with traders. If you want to be long dollars, and you do, if you want to be long dollars for this trade, we are now at that inflection point at the 115 handle in the euro. Keep an eye on this. Nice doji. This is an XFE put. This is a 6E put. This is a euro US short. This is a 6E short. So keep an eye on that one. Finally up in the zone. Overbought at that Darvis. Beautiful. All right. So, well, let's get to the questions. As always, that is what this show is all about. So jumping in, Jay Charles, why do I refer to the ES when someone asks a question about SPX? I notice SPX options change as an ES moves up and down at night. Is the ES a better indication of what to come? So, if anyone asks a question, sure, no, great observation. If anyone asks a question about SPX or SPY, why do I go the S&P? Well, this is far more liquid. It's the futures contract that I will use as a gauge for SPY and for SPX, right? So when you look at liquidity throughout, think of it as a 24-hour day. When you think about liquidity, you're going to see more liquidity. You're going to see more of that in the ES. So that's why I use the ES to gauge what SPY and SPX are going to do. So I don't look at SPX or SPY as the touchstone market. I look at them as awesome alternatives to the futures contract. So that's why I do that. Is it a better indication of what's to come? Look, they're all gauging the same thing, right? So what I'm saying is because it's more 24-hour in nature, it's what 22 and 3/4 hour. Uh, yes, I do believe because of the fluidity, the continuity of the action, it's going to give you a better insight of what's to come. Certainly better than SPY, and I do believe better than SPX. Now, that does not mean that SPX is not a great place to trade. It doesn't mean SPY is not a great place to trade. We actually day trade. I think a lot of folks may not know we day trade SPY in my Sector Secrets Mastery. That's something that we do, especially when we have those zero dated options. But those of you in the mastery know I'm still going to use the ES futures as the trigger for the SPY, and equally it works for the SPX. Okay, so thanks for the question. Good, really good one there, Jay, to kick off the morning. Hey there, James. Thanks for all the teachings, navigating this market, having an understanding of structure, sectors, and the different strategies based on structure has been very helpful. James, I appreciate that. January, we were pretty inactive, right? December was challenging, no doubt. January was pretty challenging. Towards the very end of January, we had at that point dealt with a lot of the choppiness of December. And then we glommed on to what? Where are the relative outperformers in the XLF? Where are the relative outperformers in the XLP? And that's really the mindset, that relative outperformer mindset and watch list, that when we did the watch list building on Wednesday's close, you've got an idea of where we're focused. We got into some KMI. So I'm happy with the book. It's light, and that's the way that I want it right now. But very much so. I appreciate your time. I appreciate your efforts and everyone in the mastery, because gosh, what are we doing in there? Think about it, James. And kudos to all of you that are in there with me. I'm teaching you how I day trade in there. I'm teaching you how I swing trade in there. And then come April, and a lot of you have been asking, is how do I construct and reconstruct and balance my longer term book of my portfolio? So we're going to be covering all those timeframes. So kudos to you all for being able to manage multiple time horizons and multiple time frames, and coming along with me on, what is a full look at my trading in there. So I appreciate that, James. Thank you. All right, Trader B, what is the difference between the yellow and purple Darvis lines? Darvis 2.0, what are the difference? Nothing tactically or strategically. What it actually does basically show you is a yellow box began with the high of the Darvis box first. We got the high touch point first, the high swing, if you will, and then the low. And the purple box, we got the low first and then the high. So it just maybe in a minor way says one formed in a more bearish type beginning, one a little bit more bullish. The truth of the matter is it just makes it easier to pair them up. Yellow belongs to yellow, purple belongs to purple, but the colors really don't mean anything. For us, it's automated support and resistance. It's the best automated support and resistance based on Darvis principles dating back to the 1950s. Why not use something time tested? I think so often, and part of it is, wanting to discover something better. Part of it's arrogance. We don't have to reinvent the wheel, right? We don't have to. There's a lot of great indicators where if we understand how to use them, and there's a lot of great traders and that came before us, sometimes decades, if not, Charles Dow was a century ago. They figured some things out back then that are still very much in play. And that's where most of my trading comes from. When I say we stand atop the shoulder of giants, I mean it. I like to focus on things that are decades old, right? Sort of the ancient wisdom, if you will, of trading. So that's what it is. It's just to pair up the lines. And for those of you that are in the futures room, the options room, or the Sector Secrets Mastery room, you know that I've shared the free tops layout in those rooms with the stochastic, with the Darvis 2.0, grab candles, wave, and propulsion. So you can open up that shared item and have this running on your toss platform, for the open if you wanted. So thanks for the question, Trader B. All right. I appreciate that. Why? Good morning happened upon your show a while ago. Love how I teach and my detailed explanations. My pleasure, truly my pleasure. And frankly, also my job. Thank you, though. ZC, LJ, yes, ZC is an interesting symbol. There's an inflation narrative. This is something that I talked about to the futures traders in the premium video last night. ZC is pulling back. I would not doubt if it gets down to the middle line of the wave. But this is a buy that I want to focus on. And someone had mentioned something. I thought I saw the question here about what do we need to be aware of seasonally? Not much, but what I would remind everybody is you need to be aware of the USDA agency reports. And I think we've got some reports coming out. Hey, I'm looking at my phone here. The 9th. So heads up on the 9th. I believe we have a number of crop production releases coming out around noon. So keep an eye on the 9th. So there could be some volatility. So just like non-farm payroll can just move those indices, move the stocks, USDA crop reports, think of those as sort of a central bank event, if you will, for crops, for grains, for meats, beans, corn. So be aware of that, because if we get in, we're going to be dealing with that data on the 9th, which can oftentimes really make for a lot of volatility. Walmart, Jose, if you check out Jose, and the only reason I'm going to mention the video is I walked through specifically Walmart and gold. So rather than me saying, here, this is what I see now after it's bounced. Look, if someone's going to go through a set of charts and show what has happened with whatever secret squiggle, break down a chart, 2-3 weeks ago or whatever, who cares? We know what happened, right? So I like showing you as it's happening as best I can. And I'm trying to find, here we go. I think it was this, learn this oversold setup. Here you go. This is the video back at the Simpler Trading YouTube channel. I'll push it through this was as it was happening. I said, hey, we want to get into Walmart. It looks just like gold. It's a pattern that you need to learn. Learn this oversold setup. Gang, at some point today, maybe over the weekend, check out this video. Very powerful way to understand how to use Darvis and a stochastic in a neutral market environment. So what do I think of Walmart? I think it's following through from what we talked about on Jan 28, which is we got down to this level. Heck, I'm just going to let my drawing do the talking there. Went neutral, right? Got down to the low, and now we're moving back up. And that's the whole idea. So now we're at a crossroads. And what do I mean by that? There's two places in CHOP that we need to be aware of. One of them is the 50% in terms of price. Notice how we're at the 50% in price. The other one would be the upper end of the range, right? That's the price levels where I would expect either a stall or maybe even it to turn back around and re-enter the range. The other way that we can look at this is as we're getting to, and not always, but it does tend to sync up more often than not. We get to that 50% of the chop on price, and we're oftentimes, take a look right there, will oftentimes also be at the 50% on the stochastic. Again, not just any stochastic, gang, an 80-20 overbought, oversold, 21K 3D exponential, right? And this is what I've been teaching you all since our tops class. Keep it on that halfway mark, both in price and then in your choppy market indicator. Look, Ready Aim Fire does something very similar too, for those of you that have that oscillator as well. All right, moving on. Yeah, I agree, Michael. What a week. What a week. NASDAQ, Eric, same thing that I've been saying for a while, and I think it works. It bears repeating. So thank you for the question. It's a double red market, gang. It's a double red market. Bearish momentum, bearish trend. Look at the red grab candles dominating. Look at the fact that we are struggling to get above and stay above the 200 propulsion, which is where the 200 exponential would be. This is the kind of market that's a short the rip. A lot of you hit me up in the video day before yesterday, quite a few of you. Then Mark comes to mind and said, I wish I grabbed that XLC put you had talked about, Rog, because you said, of all the weak sectors, right, within the indices, XLC is the one that we want to short, and XLY would be number 2. And there's XLY. Follow the structure. So let's talk about this for a moment. You talk about structure. What does that even mean? There's a lot of ways to understand market trends a la Charles Dow. The best way to do it, and I've been testing this for almost 30 years, right? The best way to do this is with shorter exponential moving averages. All right. So we want to focus on the 8, 13, 21, and 34. Give me 1 second here. Making a note to myself. All right. 8, 13, 21, and 34. Those are going to be far more responsive than what has classically been used, 20, 50s, 100, 200. Those are classic. We still want to keep an eye on those. But the moving averages that we study to structure out our momentum and trend are shorter, exponential moving averages. Nothing works better. And believe me, I've tested, I've tried, I've looked. That's what 30 years of watching the market with different indicators and seeing which ones respond in the best way. Not the ones that are first, but respond in the best way across the broadest types of market behaviors. What happens with a lot of folks who are testing indicators is they end up curve fitting inadvertently because they just don't know any better. What does that mean? Well, they're using a very specific amount of time to determine what indicator they should use or what setting they should use. And ultimately, all they've done is make something look good for what they're looking at, right? Versus what they could see in the future, right? 8, 13, 21. Nothing is better. The most important thing that I can share with you about the NAS is it continues to be in a bearish structure. All right. Bearish, downtrend, markdown, whatever lingo you like to use. That is where we're at. And then notice how well the wave, the 34 EMA wave, complements where that short the rip can be. Gang, every one of these tools that I'm talking with you all, again, if you're in the options room, the futures room, or the Sector Secrets Mastery, this layout with almost all of these tools. I think I've got Darvis 3.0 running on this, but the Darvis 2.0, the wave, the grab, the propulsion, the stochastic, they're all in that layout. So follow the structure of the JT multi, which is also included. You're going to find how much better, how much more accurate your trading is going to be. It doesn't get any easier than that. So thank you, Eric, for the reminder that, hey, we're in a downtrend. There's a number of places that we have downtrends. There's a couple places that we're in chop. So make sure we treat them differently, different indicators. So in my handling chop with slow stochastics, do crosses play any role? So Dan, crosses are fine. Thinkorswim will allow you, here, let me show you here. Thinkorswim will allow you to, to place some breakout signals on the slow. This is Toss's stochastic. This isn't anything fancy. You can go into Toss and set this up just as I'm showing you. Slow K and slow D, right? Exponential 80, 20, 21, 3. I would not wait for the arrow. People love arrows, right? I wouldn't necessarily wait for the arrow. The secret is in this, and it's not even a secret because I've been openly sharing this since 2018. So hopefully some of you are using it. Start with price. Darvis. Identify where that zone is. Even more importantly, make sure we're in a neutral trend, right? That's where the wheels fall off the wagon for a lot of traders. You're not starting off with that neutral chop, then going to the Darvis, and then asking, are we simply above 80 or below 20? That'll help. If you're waiting for an arrow, you'll probably be maybe a smidge behind the exhaustion. You're going to end up using some momentum. But if that's what you like, no problem. So that's the cross signal. Do they play a role? Of course, right? When they cross each other, when they cross down or up to the 80 or 20, I mean, they do, but recognize that you want to start with price first, then go down to the secret squiggle. All right. Okay. So gang, just like that, we are out of time. That 20 minutes flies by. I will see you all on Monday, same time, same station. As always, I appreciate y'all tuning in, caffeinate, and dominate. Remember, today's a caution day, non-farm payroll. Be good to each other. I'll see you all in the futures and sector secrets for our Ask Me Anything session at 3 p.m. Eastern.